Hi everybody, this is a lecture for week 5, lecture 2 for week 5. Okay, last week you have seen or watched the lecture for the first half of this chapter. Okay, now this is the second lecture for this second half of second half of this topic. In the previous lecture, you have seen the way to calculate direct material variance and direct labor variance. So this is the next one. This is the way to calculate variances for overhead costs. There are two types of overhead costs, variable overhead costs and fixed overhead costs. So let's see the calculation for variable overhead costs. So these are sample data, variable overhead rate, which is the standard rate, $3.85 per direct labor hour, actual variable overhead cost 1,600, actual hours worked 400 hours, 400 labor hours, actual overhead rate $4, bags of chips produced 48,500, hours allowed for production 378.3 hours, applied variable overhead $1,456. Okay, this is the way to calculate the variances using columnar approach. Like I said earlier, when you calculate the variance, there are two sides of the variance, dollar variance and quantity variance. So for the variable overhead variance, the dollar variance is called spending variance, and then the quantity variance is called variable overhead efficiency variance. And I think it is easier to calculate the variances using the formula. So let's see. Okay, to calculate the variable overhead spending variances, you have to use this formula. The formula is actual variable overhead minus standard variable overhead times the actual hour. So using the data that you have seen in the previous slide, the actual variable overhead rate is $40 and the standard variable overhead rate is $3.85. Actual hour is 400, so the variable overhead spending variance for this sample question is $60 unfavorable. The most important thing is you have to memorize the formula. Okay, now the second thing is how to calculate the variable overhead efficiency variance. Okay, you will use this formula, actual hour minus standard hour times standard variable overhead rate. So in this sample question, the actual hour is actual labor hour and the standard hour is standard labor hour. Maybe in other questions or other sample scenario, the allocation base is machine hour, maybe, or can be other form of allocation basis. Just remember the formula is the actual allocation base minus the standard allocation base times the standard variable overhead rate. So using the sample data, the actual hour is 400, standard hour is 378.3 hours times the standard variable overhead rate is $3.85. So for this variance, you will get $84 unfavorable. So what is the total variable overhead variance? To calculate the total variable overhead variance, you use the variable overhead efficiency variance, $84 unfavorable, plus the variable overhead spending variances, $60 unfavorable. So you will get the variable overhead variance, or total variable overhead variance. So the total variance is $60 unfavorable plus $84 unfavorable. The answer is $144 unfavorable. Okay, this is the sample for flexible budget performance report. Remember about the flexible budget. Flexible budget is a budget that you can prepare, and the budget is changing according to the unit or quantity of production, or it is changing according to basis of allocation, or any basis of increasing or decreasing, any basis that can increase or decrease the cost. So you can see here in this sample flexible budget performance report, so the cost formula is $3 for gas, 78 cents for electricity, and 7 cents for the for water. So there is a calculation there. So, and then you have to calculate two more data. First, the actual cost data. You have to show the actual cost data, and then you list the budgeted data or budget data, and then the difference between the actual cost and the budgeted cost is called the variance. In this example, for gas, the actual cost is 1190. The budgeted cost is 1200. So the difference is $10. In this case, the actual cost is less compared to the budgeted cost, so it is favorable, $10 favorable. For electricity, the actual cost is higher compared to the budget, so the variance is $73 unfavorable. For water, the actual cost is lower than budget, so you know it is favorable. The difference is $3. So if a question asks you to prepare a performance report, then you have to compare the budgeted data and the actual data, and then you have to show the whether the variance or the difference is favorable or unfavorable. This one is okay. This is the extension of the performance report. So now the table is for performance report for the week ended March 8, 2014. So let's see. The first 5 columns here are coming from the previous slide, and then okay, then you can see there are 2 additional columns. The first additional column is budget for standard hours, and then the efficiency variance. Okay, you can see there the efficiency variances are calculated by comparing the budgeted data and then with the budget for standard hours. All of the variance, efficiency variance are unfavorable, so the total is $84 unfavorable. Okay, now this is the next thing, fixed overhead variance. So these are the data. First, the budgeted fixed overhead sample data here is 749,970. Practical activity 23,400. Direct labor hours, standard fixed overhead rate $32.05. So the practical activity is hours allowed to produce 3 million bags of chips. The calculation is 0.078 times 3 million bag of chips. So the total is 3,400 direct labor hours, not the dollar. And then the actual result. So this is the actual result. Actual production is 2,750,000 bags of chips. And then the actual fixed overhead cost is 749,000. Standard hours allowed for actual production is 21,450. Actual hours is 23,400. Okay, this is the total fixed overhead variance calculation. Applied fixed overhead variance equal to standard fixed overhead rate times standard hours. So the rate is $32.05 times the standard hours is 21,450. The total number is 687,473 rounded. This is the applied fixed overhead. Total fixed overhead variance is 749,000 minus 687,473. The answer is 61,527 under applied. The 749,000 is coming from the previous slide data, and then that is, I think, the actual fixed overhead, and then the 687,473 is the applied overhead. So the difference is 61,527 under applied. This is the columnar approach. Okay, this is another thing. See here, this is about the performance report. Like the thing that you have seen earlier, performance report is if you are asked to prepare a performance report, it means that you have to show the comparison between the actual cost and the budgeted cost. See here, you can see that the actual depreciation cost, salaries cost, tax cost, and the insurance cost are compared with the budgeted cost. So you can see the some of the difference are favorable, and there are also unfavorable difference or variance. Total fixed overhead cost, you can see the numbers in column 2 and 3, and then the total variance is 970 favorable. Okay, this is the volume variance. spending variance. Okay, this variances for the fixed overhead cost. Okay, this is another thing. Flow of cost through manufacturing accounts. So for management accounting, the focus is on the manufacturing businesses. Manufacturing businesses are businesses that purchase raw material, process the raw material, and sell finished product. So let's see the flow. The flow is direct material cost, direct labor cost, and manufacturing overhead costs are debited in the work in process inventory account. When the process is completed, the work in process inventory account is closed, and the amount is posted or transferred to finished goods inventory account. And then when the finished goods inventory is sold, the amount is closed and transferred to cost of goods sold account. And then at the end of the accounting year, the amount in the cost of goods sold account will be shown in the profit and loss account. Mix and yield variances for material and labor. Okay, the mix and yield variances is related to calculation of variances when there are more than one direct material used to produce a product. So let's see this example. So direct material, there are two direct materials examples here. Example here, peanuts and almonds. The mix is 128. I don't know how to mention this, how to pronounce this, LBS. And 32 LBS, the total is 160 LBS. So the mix proportion is 80% and 20%. And then here the standard price is 50 cents and $1 for 1 LBS. So you can see there, for peanuts, the standard cost is $64 per LBS. Sorry, $64 for one product. And then almonds is $32 per product. I think this data is direct material cost and quantity for 1 unit of product. The yield is 120 LBS, and the yield ratio is 75%. Standard cost of yield is 80 cents per pound. The yield means that you see there, the peanuts and almond, to produce 1 unit product, 128 LBS of peanuts are needed and 32 LBS of almonds are needed. The total is 160 LBS. But when the process is done, the output from the process is 120 LBS product. So the yield ratio is 75%. What it means by the yield ratio? The yield ratio is what is the output from the mix of two variable. mix of two materials. The total mix is 160 lbs, but from that only 120 lbs is useful, can be is the output of from the process. So it is, the yield ratio is 75%. So standard cost of yield is equal to, or standard price is equal to 80 cents per pound. How to get the 80 cents per pound? $96 of the standard cost divided by the 120 pound of yield. So lbs can be is pronounced as pounds, I think. Okay, pounds. Okay, let's see here. This is another example. Malcolm Nuts company produces a batch of 1,600 pounds and produces the following results. Produces a batch of 1,600 pounds. Okay, so the number here, direct material 2 peanuts and almonds. The actual mix is 110 pound for peanuts and 480 pounds for almonds. So the percentages is 70% and 30%. So the yield, see there, the direct materials total is 1,600 pounds, but the output from the process is 1,300 pounds only, or 81.3% of yield ratio. So what is the standard mix? Standard mix proportion times total actual input quantity. So standard mix for the peanuts is 0.8 times 1,600 pounds. The result is 1,280 pounds. Standard mix for almond is 0.2 times 1,600 pounds, equal to 320 pounds. So the mix variance, if there is a question asks you to calculate mix variance, then the answer is actual quantity minus standard mix, and then times standard price. So this is the way to calculate the mix variance. So peanuts 1,120, standard mix is 1,280. Actual mix minus standard mix is 160. The standard price is 50 cents. So the variance is $80 favorable. Almond, the actual quantity is 480. Standard mix is 320. Actual quantity minus standard mix is 160. Standard price is $1. The variance is $160 unfavorable. So the mix variance is equal to $80 unfavorable. Why $80 unfavorable? Because the amount of, or the variance of unfavorable here is higher compared to the amount of favorable. Direct material yield variance. So this is the calculation for direct material yield variance. Standard yield equal to yield ratio times actual inputs. Yield variance is standard yield minus actual yield times standard price. So the yield variance is, in this example, 1,200 minus 1,300 times 80 cents. The answer is $80 favorable. Oh. Okay, let's see there. this one is another thing. Standard mix information, shelling and mixing. 3 hours and 2 hours mix proportion is 60% and 40%. Standard price is $80 and $15. Standard cost is $24 and $30. Total 5 hours is $54. Yield 120 pounds. Yield ratio is 24. Why 24? Because you use the 120 pounds divided by the 5 hours, or 2,400%. Standard cost of yield or standard price of yield is 45 cents per pound, which is equal to $54 divided by 120 pound of yield. Malcolm processes 1,600 pounds of nuts and produce the following actual result. This is related to the process, I think. Shelling and mixing is the process. Okay, let's see here. Standard mix information, actual mix percentages, total 100%, 50 hours yield is 1,300 pounds. The mix percentages is 2,600%. Use 50 hours as the base. Okay, this is the direct labor mix variance. The total is $70 unfavorable. And then direct labor yield variance, standard yield minus actual yield times standard price of yield. And then you will see the number is 24 times 50 minus 1,300 times 45 cents. The answer is $45 favorable. The yield variance is favorable because the actual yield is greater than the standard yield. Okay, this is the end of the slide for this chapter. There are a lot of things. There are many variances that you have to know. Remind me to provide you with a list of variances and their formulas that you actually need to focus on. I hope if I can give you the list, then you can focus on that variances, and you can do or you can read more about it, and you can do more exercise related to the variances that are actually relevant for this course. Thank you very much. Do not forget to write your metric number in the comment section, and feel free to ask question also in the comment section.